The stock market has a habit of rewarding patience more than prediction. While most investors spend their time reacting to daily headlines, earnings surprises, and short-term price swings, professional analysts tend to focus on where the market could be 2, 3, or even 5 years ahead. As we look toward 2026, a new phase of growth is expected to emerge, driven by long-term trends like artificial intelligence, digital payments, healthcare innovation, and cloud infrastructure. In this video, we'll explore 5 stocks that many analysts believe are well-positioned to outperform by 2026, not because of hype, but because their businesses align with powerful structural shifts in the U.S. and global economy.
It's important to understand that outperforming doesn't always mean explosive gains overnight. Often, the strongest performers are companies that steadily compound value over time, supported by strong cash flow, durable competitive advantages, and consistent demand. Analysts look beyond stock prices and focus on fundamentals such as revenue growth, margins, market leadership, and long-term scalability. With that perspective in mind, let's begin with a company that continues to define modern technology infrastructure. Microsoft is frequently described as a safe stock, but analysts argue that description undersells its growth potential. By 2026, Microsoft is expected to benefit significantly from the continued expansion of cloud computing and enterprise artificial intelligence. Azure has become a critical backbone for businesses, governments, and institutions across the United States, and its integration with AI tools gives Microsoft a unique edge. Instead of relying on a single product, Microsoft embeds AI across Office, enterprise software, cybersecurity, and cloud services. This creates recurring revenue streams and makes it difficult for customers to leave the ecosystem. Analysts see Microsoft not just as a technology company, but as a long-term productivity platform that grows alongside the digital economy. Another stock that analysts continue to highlight for 2026 is NVIDIA. While some investors worry about valuation, analysts point out that the artificial intelligence cycle is still in its early innings. NVIDIA's chips are essential for data centers, advanced AI models, and high-performance computing, making the company a key supplier for some of the most powerful trends in technology today. As AI adoption expands beyond big tech into healthcare, finance, manufacturing, and government, demand for NVIDIA's hardware and software ecosystem is expected to remain strong. Analysts believe that by 2026, AI workloads will be more complex, more widespread, and more critical, reinforcing NVIDIA's dominant position. Moving away from traditional tech, analysts also see strong long-term potential in Visa. Unlike companies that depend on consumer borrowing, Visa benefits from transaction volume, not debt levels. As cash usage continues to decline and digital payments become the norm, Visa acts as a toll collector on the global financial system. Every swipe, tap, or online payment generates revenue, regardless of economic cycles. Analysts believe that by 2026, growth in e-commerce, mobile payments, and cross-border transactions will further strengthen Visa's business model. Its high margins, strong balance sheet, and global reach make it one of the most consistent compounders in the market. Healthcare is another sector analysts believe could play a major role in outperformance over the next few years, and Eli Lilly stands out as a key example. The company has gained attention for its leadership in treatments related to diabetes, obesity, and chronic diseases, areas with growing demand in the United States. Analysts point out that healthcare spending tends to rise regardless of economic conditions, making companies like Eli Lilly more resilient during market downturns. With an innovative drug pipeline and strong pricing power, Eli Lilly is viewed as both a defensive and growth-oriented investment, a rare combination that could pay off through 2026. The final stock analysts frequently mention is Amazon. While many investors still associate Amazon primarily with online shopping, analysts increasingly see it as a diversified technology and logistics powerhouse. Amazon Web Services continues to dominate the cloud computing space, while advertising and automation are improving profitability across the business. Analysts believe that by 2026, Amazon's operating margins could be significantly higher than today. As efficiency improves and high-margin segments grow, the company's ability to reinvest cash flow into innovation gives it long-term flexibility that few competitors can match. What connects all five of these stocks is not short-term momentum, but long-term positioning. Analysts focus on companies that already lead their industries and have the resources to adapt as markets evolve. These businesses are not immune to volatility, but their scale, innovation, and financial strength allow them to navigate uncertainty better than most. In fact, analysts often view market pullbacks as opportunities to build positions in these types of companies rather than reasons to exit. Another key point analysts emphasize is time horizon. The stocks most likely to outperform by 2026 are rarely the ones making headlines today. Instead, they are companies quietly expanding their influence, improving efficiency, and deepening customer relationships. Holding through cycles rather than reacting emotionally to market noise is often what separates successful long-term investors from short-term traders. Of course, no stock is guaranteed to outperform, and this is not financial advice. Market conditions can change, and every investor must consider their own goals and risk tolerance. However, by focusing on companies supported by strong fundamentals and long-term trends, investors increase their chances of participating in sustainable growth rather than speculation. As we move closer to the next market cycle, the real opportunity lies in preparation, not prediction. Analysts are already positioning for 2026 by identifying companies that are likely to be stronger, more profitable, and more relevant than they are today. The question isn't whether markets will fluctuate along the way, but whether you're aligned with businesses built to thrive over time. If you want more long-term market insights, data-driven analysis, and realistic investing perspectives focused on the U.S. market, make sure to subscribe. The future of investing is being shaped right now, and the smartest moves are often made well before the crowd notices.